Welcome back to Boring Currency, where we track physical metals, paper market stress, and the forces reshaping the global financial system. It is February 2026. The markets are shut. Trading terminals are dark. Yet behind the sealed vaults of New York's commodity exchange, something that should not exist is forming. We are now exactly a few days from first notice day for the March delivery cycle. And the data released last night confirms a structural rupture inside the system. Current open interest represents claims on 429 million ounces of silver. But within the registered vaults, the metal actually approved FOR delivery, only 103.5 million ounces remain. The margin of safety has vanished. The paper firewall has collapsed. Listen carefully, because what follows is not speculation. It is a mathematical inevitability tied to the solvency of the global exchange itself. Now let us dismantle what has occurred inside the exchange over the last 100 hours. To grasp the severity of the March crisis, we must first examine the smoking gun fired in February. In a normal futures market, contracts exist for hedging and speculation. Traders buy paper exposure, wager on price movement, then roll forward or settle in cash before delivery. In a functioning system, only a small minority ever demands metal. Historically, that number sits between 2% and 5%. During extreme stress, it might spike to 10%. But February 2026 shattered that framework. The month began with 19.11 million ounces of open interest. By February 4th, just days later, 18.72 million ounces had already stood for delivery. Run the numbers. That is a 98% delivery rate. Pause and absorb that. 98% of contract holders refused to roll. They rejected cash. They demanded bars. This is no longer a futures market. It is a physical allocation system, a vault run. That 98% figure is the largest anomaly in the modern history of the exchange. It represents a total collapse in confidence in paper pricing. When nearly every participant demands immediate metal, it signals one belief: the silver will not be there next month. And they are correct. Because if we rewind just 30 days to January, we see the same behavior, on a larger scale. January is typically a minor delivery month, a quiet staging ground before March. But January 2026 broke that pattern. The exchange delivered 49.4 million ounces of silver. That is 4.17 times January 2025 and 7.27 times January 2024. Why rush nearly 50 million ounces out of a minor month? The answer is front-running. Smart money saw March approaching. They ran the inventory math. They saw production deficits. And they understood waiting for March was fatal. So they moved early, draining the vaults in January before the public recognized the shortage. This brings us to the most critical metric: depletion speed. In October 2025, registered silver stood at 167.7 million ounces. As of this morning, February 7th, it has collapsed to 103.5 million ounces, a 38% loss in just over 3 months. The current drain rate is 785,000 ounces per day. Nearly 1 million ounces disappear every sunrise. Project that forward to February. Registered inventory likely falls to 85 million ounces. Here is where the math fails. March open interest equals 429 million ounces. Even assuming a conservative 25% delivery rate, required metal equals 107 million ounces. Available supply, 85 million. That is an immediate shortfall of 22 million ounces. And that is the optimistic scenario. If behavior mirrors February's 98% rate, or even January's 50%, demand explodes to 200 to 300 million ounces against 85 million available. This is why February matters. Participants are no longer seeking price exposure. They are sourcing industrial metal unavailable elsewhere. The exchange has become the supplier of last resort. This shift began in 2025. Total deliveries doubled year over year from 203 million ounces to 474 million. Every month in 2025 exceeded its 2024 counterpart. This was not noise. It was acceleration, a slow stampede reaching terminal velocity. We are watching the liquidation of Western silver stockpiles. Infinite paper leverage is colliding with finite physical reality, and physical is winning. Those standing for delivery are not speculators. They are industrial users, sovereign funds, and Eastern banks who understand silver's price is artificially suppressed by the very contracts they are converting. They are extracting metal while it remains cheap. But the clock is ticking. At 785,000 ounces per day, Inventory is counting down to zero. When that happens, global price discovery resets. We are few days from official demand exceeding supply. February was the warning. January was preparation. March is impact. To grasp the cliff ahead, we must examine the path that led here. This is not a short-term squeeze, not a hedge fund event. Overlay 2024 delivery data with 2025 and a disturbing pattern emerges. In 2024, total deliveries reached 202.7 million ounces. High, but manageable. The system functioned. Then came 2025. Something broke psychologically. Deliveries exploded to 474.4 million ounces, a 2.34x increase. Every single month exceeded the prior year. January doubled. February quadrupled. March jumped from 27 million to 80 million ounces. This was a 12-month liquidation campaign. Metal moved relentlessly from vaults into private hands. Historical parallels are rare. The Hunt brothers in 1980 were aggressive buyers driving price higher. This is different. This is defensive. This is a bank run. Depositors flee systems they no longer trust. That is exactly what is happening now. The doubling of deliveries signals that counterparty risk is unacceptable. Paper promises are being abandoned for bars. This is also geopolitical. For decades, Western markets controlled silver pricing through leveraged futures. That illusion only works while metal stays put. Once it leaves, leverage collapses. The 474 million ounces delivered in 2025 represent a massive west-to-east wealth transfer. This silver is not returning for paper dollars. In 2011, silver hit $50 with higher inventories than today. That rally was retail-driven. Today's move is wholesale accumulation, a far more dangerous dynamic. Industrial buyers do not sell, they consume. We moved from 200 million ounces in 2024 to nearly 500 million in 2025. And 2026 is accelerating faster. The system was built for a trickle, not a tsunami. Now skeptics point to eligible silver, 294.5 million ounces, as the safety valve. They claim it can be converted to registered. This is the most dangerous misconception in the metals market. Eligible silver meets standards and sits in approved vaults. But it is privately owned. It is not for sale. Conversion requires owner consent. Ask yourself, would you sell now after watching registered inventory collapse 38% in 3 months? Would you bail out banks shorting your asset? Of course not. You would hold, or withdraw entirely. And that is exactly what data shows. Eligible inventory has fallen from 329 million ounces in October 2024 to 294 million today. The backup supply is bleeding too. Owners are tightening their grip because silver is no longer just monetary. It is strategic. Green energy, AI data centers, EVs, defense systems, all require silver. It is irreplaceable. Production lines stop without it. For manufacturers, price is irrelevant. Availability is everything. This explains the accelerating drain and sets up the May nightmare. Even if March somehow clears, May open interest has already surged from 105 million to 132 million ounces. If March empties the vault, where does May's metal come from? Mining is flat. Recycling is maxed. We are hitting a mathematical wall. Once registered inventory hits zero, backwardation becomes permanent. Physical prices decouple. Paper contracts become meaningless. Eligible holders will not sell. Premiums explode. This belief that eligible silver will save the shorts ignores human behavior and Gresham's law. Bad money flees, good money hides. We are few days from truth. Vault doors are rattling. Now we reach the final calculation. These are constraints, not opinions. 2 scenarios exist. Neither favors paper holders. Scenario A, a conservative 25% delivery rate. That requires 107 million ounces. Available, 85 million. Deficit, 22 million. Insolvency on day 1. Scenario B, February-style panic. 50-70% delivery. Demand, 200-300 million ounces. Supply, 85 million. Impossible. So what happens? The exchange declares force majeure. Delivery becomes impossible. Contracts are cash-settled at paper prices. And this is the trap. The screen may say $35. Dealers will have nothing. Physical silver will cost $50, $80, or be unavailable. Paper price discovery ends. The industrial giants know this. Eastern banks know this. Now you do too. Even if March survives, May waits. If March drains inventory, May has nothing left. This is self-consumption. Eligible holders understand possession is everything. A receipt for non-existent silver is worthless. Cash settlement in debased currency destroys purchasing power. I am not a financial advisor, but I can read maps. And this map leads to a cliff. Do not trust the ticker. Trust the weight in your vault. If you do not hold it, you do not own it. The storm is no longer coming. It is here.